Hello, everybody. I'm going to wait just a minute here while we have, we'll give people a chance to stream in. I see the numbers are still climbing for the attendees. So my name is Brian Basinger. We're going to be getting started here in just, I don't know, maybe less than a minute. If we can have you guys just type something in the chat to make sure that it's working. If you could just put in where you're from and what kind of business you own. That'll give me a sense of who's here and let us make sure that the chat is working. So throughout the chat, throughout the webinar, what I'll be doing is trying to keep an eye on the chat. We've got Jared, who's also helping out, and Jared is really going to be diligent with the chat, and he'll make sure that any questions you have, if I can't get to them throughout, if I don't see it, or whatever the issue is, he'll save them all for the end. And then we'll get in and make sure that everyone's questions are answered at a minimum by the end. If I can, I'll go through and answer them throughout. So let's see, we've got Jenny from Wisconsin, awesome, with a consulting business. I guess Jenny's the only one who's feeling participative today. Let's see who else we can get. We've got several of you here. Alex, Cameron, Carissa, let's see. All right, Brennan from Colorado, life insurance, also awesome. Let's see, Jackson, Jessica, Carla, Natasha, Ryder. What's we got? Let me know where you're from and what kind of business you're in. I'm going to go ahead and get started. But if you could, again, just put that in the chat, make sure it's working, because that will be how we answer questions. Okay, I see a couple of you. Thanks, Ryder. Daniele from Washington. Awesome. Okay. So you're probably here because you own a business of some sort and you're looking to figure out how you can lower your taxes or get additional financial control. Really what we're after with businesses is we're trying to build wealth. That's why most of us, start businesses and are doing this. Let's see. I got distracted. I've got this weird glare on my face that I just noticed coming in out the window, but nothing I can do about it. So let's see. The main thing that I guess I want to emphasize overall is that it's possible. Like on average, we've crunched the numbers for our clients and looked at the overall trends. It's one of the advantages of being a CPA is just being able to have an exposure to a lot of businesses that you can kind of observe and see what's working and what's not. And on average, most small business owners are able to go from just bootstrapping a business, just barely getting started with nothing, to having 7-figure wealth in under 8 years. And today we're going to talk about how more broadly, and then more specifically, we're going to get into some of the tax strategies as an initial step to accelerating that process of wealth accumulation. So quick disclaimer, any and all business always carries inherent risk, and all the numbers that we're going to use in this presentation, they are for real clients, for their specific data sets, as explained. A lot of people set out on entrepreneurial journey and business opportunities, and they fail, and this is no exception. We don't make any claim to your ability to achieve wealth, nor to Contigo Advisors' ability to help you grow your wealth. And this fun disclaimer is required by law. And there we go. So this probably is not your first rodeo. It's probably not your first webinar with some sort of a promise or a hope of finding answers and finding financial solutions. And if you've struggled with this in the past, and if you just haven't been able to kind of grow wealth as much as you want or lower your taxes as much as you want, I just want to let you know, honestly, it's not your fault. There is so much information out there. It's really hard to know. And one thing I hear over and over and over again as I talk with entrepreneurs is, I don't know what I don't know. And that's in a sea of information, because there's so much that can kind of keep you like you're drinking from a fire hose, and it can actually keep you from boiling it down to the information that is the most important and that you actually need in order to hit and achieve those goals. So if you've been concerned in the past that you just can't get there and can't realize, those tax or wealth goals, if you've been stressed about money or stressed about your taxes and kind of unable to control it for a long time, I just want to put those fears to rest. You just need to understand the right model to actually unlock the cash flow that is available to you as a business owner. And that's kind of been, right there the whole time. So a lot of CPAs and frankly, the IRS and Wall Street and sort of the overall financial complex of the country kind of likes the idea of you feeling like it's too complicated and like let them handle all this stuff and you just kind of go about your business, just follow that traditional path, and that's what's going to have you be successful. Just get a job or even work in your business, but look at it like more of a self-employment deal and get your income, pay 40 to 50% in taxes, invest into Wall Street, wait 30 or 40 years. And then at the end of it, you can have enough to kind of survive your way through retirement. Not ideal and not that great when you kind of phrase it that way. But I'm here to tell you that that is simply not the truth. There are better options, and you really just need to understand a few basic principles. It's not even, it's not even rocket science. Most of the wealthy people in this country, at a minimum that I've had a chance to observe firsthand, do not have crazy, insane structures. They are aligning themselves with some basic principles and some incentives that the government has put into place to help encourage certain economic activity. And that just opens a door of profits, of cash flow, of investing, and ultimately wealth, which is what we're after. So that's what we're here for. I just realized something. I'm in the wrong presentation, so I'm gonna fix that real fast. There should be a little bit a different slide right here, so I'm gonna go grab it. Okay, sorry about that. And I've got it now, so I'll reshare. Okay, I gotta reorganize this. All right, so that's what we're here for. That's what we're going to talk about, is this idea of how do we ultimately generate that wealth as small business owners. And I'm going to show you the exact steps that I followed, that many of my clients have followed, and how you can replicate those steps for yourself. Really, this is intended to help two different types of business owners. First, if you're under $350,000 a year in profit, then you're going to get a new financial model that's going to allow you to never stress about cash flow and be able to achieve seven-figure wealth 3 to 4 times faster than what you've been taught to expect. If you're over $350,000 a year, then I'm going to show you the blueprint to scale that to over $1 million by finding and reclaiming these 5- and 6-figure dollar amounts that are being lost every year, just sort of leaking out the bucket to bad expenses, including and especially what we're going to focus on today is tax. So my goal is to get you to believe that proactive tax and wealth planning is the key to unlocking your business profit and ultimately the wealth that you're after. My name is, again, Brian Basinger. In the last 12 years, I've had a chance to help save my clients over $10 million in taxes. And I've helped dozens of clients go from new struggling business owners who are just bootstrapping their businesses to wealth savvy millionaires who not only have achieved it, but also understand and are able to really have a control over their finances and their wealth and their taxes. And ultimately, I was able to make a 7-figure exit from the firm that I started. And now I have kind of shifted my focus, and I'll talk about this here in a little bit, but I've shifted my focus to trying to help newer entrepreneurs. In the firm that I had, we were really geared more towards helping entrepreneurs that already had lots of money save their taxes. And I'm shifting now to try and help newer entrepreneurs who maybe can't afford those high-priced CPAs to figure out how do you get on that path towards financial freedom, and how do you do it quickly so that you can not struggle for decades, but kind of get right to it. But honestly, it wasn't like this for me all the time. I had to figure out, I had to kind of go through my own journey. I was stuck at a corporate job that I hated. I was trying to grow my firm as a side hustle, and I was not getting enough sleep. I was not spending enough time with my family. I was always just stressed about money, stressed about business, trying to figure this stuff out, and honestly feeling like a failure, feeling like there was something wrong with me. And I was just kind of just one of those dreamers who couldn't actually do what I intended to do. And I tried a lot of different things. I tried increasing my sales and focusing on that, and just if I can just sell more. I tried changing my pricing around for the same reason. I tried hiring and firing different team members to see if I could find the right team member to help me. And ultimately, nothing was just working the way that I wanted. Clients weren't getting taken care of the way they needed to get taken care of. I was always stressed about money. I was always thinking about work. I was unable to enjoy even the time that I was spending with my family. And really what was most frustrating is I was just unable to make progress. I was unable to watch myself going from step to step to step and actually feeling like I was heading in the right direction, regardless of the amount of time that it was going to take. So I had to find a better way. And ultimately I ended up seeing an ad online for this guy, Andrew Argue. And he's a coach who helped CPA firms get their firms launched. His program cost $6,000. And I remember how just gut-wrenchingly scary that was for me at the time. One of the big shifts that we have that probably a lot of you can relate to, whether you've gone through it or whether you kind of haven't gone through it yet, is as employees, the only way that we can achieve any sort of financial stability, because the top line is fixed. So the only control we have is how much we spend. And so we have to control and restrain how much we spend, because that's it. There's nothing we're going to spend really is going to make us more money as employees. And that was the mindset I was coming from. And it was so incredibly scary for me to drop this $6,000 that I was hoping, that was part of the savings that I was planning on using to make this jump. But it was also the best decision that I've ever made. I've made, now years later, I've made so many bigger financial decisions than that, but that was the scariest. And that was also the best because it set me out on this path of investing into myself, learning and growing and understanding actually how to do some of these things and being able to take control and ownership over my own life and my own success. So for the next 7 years, I went on this journey of growing myself individually, my business, growing as a leader, growing financially and in my own financial understanding. And I had been stuck around this $50,000 a year side hustle thing for 4 years. And then this was the inflection point. And then every year it went up, until eventually I hit that point of being able to exit, pursue other things that I was a little more passionate about, which honestly, this is one of those things, being able to help newer entrepreneurs, more newer entrepreneurs, so that you guys can make the same journey instead of just helping people that kind of already have money and are already in that spot. So I started to notice these trends within my clients that a lot of them, if you look back from the time they started till the time they kind of hit that 7-figure mark in terms of wealth, and that just being kind of a benchmark for financial stability, where you can kind of shift and say, okay, I don't have to worry so much about the day-to-day. I can focus on growing my legacy over time. And the average time was 7.91 years. And the average wealth by that end of year 8 was $1.23 million. So significant. This is doable. This happens. It happens regularly. And it's not the other thing, this is on average. It's not everyone. There are the people who don't do anything, and there are the people who do way better than this. And we're going to talk about, a couple of those, but this isn't like the get rich in 3 months thing that I can't stand. It's if you just do these 2 things, you're gonna, you'll triple your business in 3 months. That stuff doesn't happen. At least it doesn't happen as far as I can tell, except in extreme exceptions. And those are the rare cases. in general, this is a bit of a longer process, but what's that Bill Gates quote? Like we overestimate what we can do in 1 year, and we underestimate what we can do in 10 years. And really, it is totally realistic to be wealthy and financially free within 10 years, particularly as a business owner. So Aaron started a cleaning business. I mean, this is not, I love Aaron's story because it's like he started a tech company. He started a cleaning business doing like nothing. I think maybe he did like $20,000 his first year. Within 8 years, he had done a 7-figure exit with zero debt. And he then flipped his role from that of owning this business into an investor. And he's invested now in multiple real estate properties. He's flipped multiple of them. He gets all the tax benefits associated with that. And he's invested into multiple businesses that are generating cash flow. That was done all in 8 years from zero. Chase also started a marketing agency with a partner in 2015. He achieved 7-figure wealth in 4 years. And now he's shifted into a mostly passive role. He's still involved. So it's not like everybody has to do this exit, but he's shifted his role to be more passive. And now he's just collecting these cash flow annuities from a couple of different businesses that he started in. And he's involved in 6 real estate properties right now, including both residential and commercial. And he has just shifted into this role of managing assets and controlling these from a distance without being day-to-day involved in any of them. And the real reason why this trend was possible was because these people had financial control. And hold on, I just realized I lost the chat, so I haven't seen anything, if there's been anything in there. Okay, so the real reason this is possible is because they had financial control. That created kind of a stable foundation and a platform so that they could focus their energy on actually growing the business and achieving and like taking care of clients and growing revenue, and not then losing it all out the back end because they didn't have any control over what happened financially. This graph is kind of small, but the real cost of poor financial control is in these trajectories. Like over these first couple of years, it's not all that different. But if in year one, we have 2 business owners that start in the same place, and one of them overpays their taxes by $5,000 and the other doesn't, and is able to take that same $5,000 and put it back into their business and then get a little bit of extra growth. And then the next year, they're able to save, they have that little bit of additional growth, plus they again avoid overpaying in taxes. And then, just keep going down that trend. And then you have for that second business owner who maybe isn't controlling their taxes and doesn't have an understanding of what to expect financially, all of a sudden they're getting hit with a tax bill that maybe is like a $10,000 surprise tax bill or a $15,000 surprise tax bill. And what does that do to that business owner in terms of taking their energy and their time and their focus and their passion away from their business and putting it into just being stressed and trying to deal with this surprise tax bill? So not only are they paying more, but it's a surprise and they're not able to predict their cash flow. And that stuff has major, major effects. And what it does, it just slows down the beginning of this curve. Like this curve is what it looks like for most business owners, is one of these two things, but it's always pretty slow at the beginning. I shouldn't say always, it's not 100%, but almost always. It's like businesses go slower at the beginning than we expect them to. And then it's in those future years that we start building on the foundation that we've laid in those early years. And if we make these financial mistakes that keep us stuck in those early years, then it just takes a long, long time to eventually work our way out of it. The stable financial foundation is the key. Not the only thing you have to do, but it's the key to setting you up on a stable platform so you can continue to grow. Like you have to have sales, you have to have repeat customers, you need to have assets that you can invest. You need to, wrong order here, but like you need all these things. You need delivery and ops. You have to have a team that can help you with some of this stuff. You need to manage your risk and be diverse, but ultimately you have to have the financial control. Otherwise, everything else kind of collapses in on itself. That is the keystone that keeps all these other things up. Otherwise, you can just have more and more and more sales, but it's all coming out the bottom and it doesn't end up mattering. So where should you start? Really, the answer is taxes are the easiest place to start. And there are a couple of reasons for that. The first one is just in principle, what taxes do is when you're being proactive about your taxes is it helps you to predict and look out and say, okay, well, what's coming? What events are happening over the next year? In order to predict taxes, we have to have an idea of what your project is going to be. What your profit is going to be. So now we have to think about that. We have to have an idea of what assets are you going to purchase or equipment or anything. What are the major financial things that are coming? So it forces us to start thinking about some of these other financial things. What investments do you want to have? Do you want to buy a piece of real estate next year? Or do you want to buy a piece of real estate this year? We have to start thinking about those things first so that we can prepare for taxes. So taxes gets us going in all these different areas. And again, it shifts this focus from being completely retroactive and just saying, well, let's look at the financials maybe for last month, if you even do that, because a lot of business owners don't, to saying what's coming. Let's shift the focus to going forward. And the second reason is it gives us quick wins. So you've got estimated tax payments every quarter. Maybe you just made one today or yesterday for the second quarter, but every single quarter you've got estimated tax payments. If you can figure out now how to lower your taxes dramatically for this year, then you can maybe skip your next quarterly tax payment and put several $1,000s back into your pocket, back into your business, and allow you to then take that and again, put it back into the engine that accelerates growth. What we're trying to do is create this flywheel here that's slow at the beginning and then accelerates over time. And taxes are simply the best place to start that because they're often one of the biggest problems that ends up derailing business owners is these surprise tax bills or just overpaying and kind of dying this death of 1,000 cuts because you're sending an extra $10,000 to the IRS every single year that should be going towards building your wealth. So how do we do that? How do we create long-term wealth using tax planning? The first one, which I talked about a little bit, is situational awareness. And situational awareness means first understanding your relationship with your CPA and your accountant. And understanding if your CPA or accountant is what I call a big A accountant. Honestly, if that's the case, you're probably not here, or you probably wouldn't be here. But the big A accountant is the accountant that charges big dollars and has fewer clients and goes really deep and takes really good care of those clients. And really, there's nothing wrong with that relationship. But that's not the relationship that most small business owners are in with their accountants. They have what I call little A accountants. And little A accountants have lots of clients that they charge a lot less money to. And really, those clients are just paying them to prepare a tax return. But the problem is, both of these accountants have CPA usually written above their door or on their website. They're both CPAs. So how do you know the difference between who's who and what, which one you're getting? And most people sort of intuitively know. But if you have a little A accountant, it's not realistic to think that they're going to be doing tax strategy for you. They might say they will. They might be well-intentioned in saying that, but generally speaking, it's not happening simply because that's not how their business is set up. They're getting paid for a tax return, and when you email them in July, that's why it takes them 3 weeks to get back to you, because they've got a stack of other tax returns they're trying to get to. And getting those out the door is where they make their money. And shifting that around to say, hey, I'm going to take half a day or a day and just think about you and your situation and talk to you and think about strategies. There's not set up for that. It's just not, how it is. So the problem is getting worse. Like these are, go quickly here. These are just new small business applications. And you can see the spike over the last couple of years. And there is not a related spike in number of accountants out there. So these little A accountants have more and more clients coming to them. They're more and more pressured to just get the tax returns out the door, less time to spend on each individual client. So you have to understand your current taxes. That's the baseline. What are you going to pay in tax this year if you don't make any strategic changes? Just that's the baseline. You should know that. You should know that now. Like, what do you anticipate your profit's going to be for this year? What does that look like in taxes? And then we can get to strategies. What can we do about it? But as a baseline, we've just got to know, if we don't do anything, what are you going to owe next April? And there's a scorecard that we use to evaluate this, and it basically centers around these items. So, what is your effective tax rate? That means on each additional dollar of income, what percentage of tax are you paying? What is your tax to earnings before tax? EBITDA is like just kind of a dumb accountant thing. Like a lot of you may not be familiar with how that is. It stands for earnings before interest, tax, depreciation, and amortization. But it's a fancy way of saying just kind of pre-tax, baseline, probably the way that you inherently kind of think about cash profit in your business. So cash profit before we take deductions and all those extra stuff to your overall tax rate. How much you paying? Your QBI deduction, qualified business income deduction. This is a critical one for small business owners, but a lot of small business owners, particularly as they start to make a little money, will end up not setting themselves up correctly and phasing out of it. And it's 20% of your business income. So it's a huge deduction. If you've got, you can all add 20%, I guess, but if you've got 200,000 of income, it's a $40,000 deduction. It is major. The other one is passive loss carryover. Do you have passive losses? Usually those would be on real estate that you can't use and can't access, that are just sitting there. That's it's an untapped resource. It's just a waste sitting there on your tax return. So we want to make sure that we're looking at and finding any of those. The other one are big ticket expenses. Are you deducting all of these expenses? What we're trying to do is shift as much of your investing and expenses from things you pay for after tax and things you do after tax to things that you're doing before tax. So we want to look at those bigger items and make sure that as many of them as possible are shifted up and are deductible pre-tax instead of paying tax first and then covering those with what's left over. And next is understanding future goals. So where are you going? Do you want to sell your business in a couple of years? Do you want to get involved in real estate? Do you want to keep your business but just spend less time in it and turn it into something that's passive and you can start to take cash flows from it? Do you want to buy a vacation house? Do you want to just, any of these things? What's coming down the road? And once you know what's coming, and once you know where you're at, and then once you know where you want to go, then we can start to map a path between those 2 points. And then between those 2 points, there will inevitably be some obstacles. So for example, you want to buy a new house next year. That's going to require a loan. Well, one of the common, fallacies out there is, well, I've got to show more taxable income to qualify for the loan. It's kind of true, but it's not true if you're actually being proactive about it and thinking about, well, okay, how can I not pay more tax and qualify for the loan? And there are several ways to do that. Generally, it would involve the financing and bringing on of additional assets that you can depreciate and take those as expenses without parting way with all of the cash associated with those. So if there's some kind of an asset you can buy, anything from something as kind of frivolous as a vehicle to any other kind of fixed asset that is beneficial in your business. All the way, computers are smaller assets, but depending on what kind of business you're in, any kind of equipment or machinery are things that you can depreciate and take a major deduction for this year. But ultimately, for purposes of your loan, the loan officer will add back depreciation. So that it could even be a smaller piece of real estate that you buy. But anyway, there are so many ways to think about that where we say, okay, well, how do we not pay more tax? How do we still pay less tax and do it in a way that the loan officer will be satisfied and be able to give the loan you need? But we can't do those things retroactively. This has to be proactive. And this is the overall shift, is from just thinking about taxes as far as what already happened and just putting the right numbers in the right boxes to thinking about it proactively and saying, how do we get to where we want to go, so that when we get there, the tax preparation is just the period at the end of the sentence. All right. Then we get, after you are situationally aware, right? You know where you are, where you want to go, and then what obstacles are going to be between those 2 points. Then we start saying, okay, well, what are the strategies that we can use to work our way around those obstacles? And those come down to 3 major areas. The first one is entity structures. The second one is deductions and credits. And the third one is wealth strategies. And that's basically how we use investments, how we shift your income around between different entities and different structures to get you in the lowest tax bracket possible. So we'll dive in and talk a little bit about each one of those now. I'm going to take a drink real fast. Okay, entity structures. So there is one overall setup for entity structures that is kind of the general way that you should be thinking about this. So you have your 1040 personal return right here, and you will have one of 2 different types of activity going on. You will either have ordinary income activity or you will have passive income activity. And for the most part, those should be run through different entities. You'll have one for ordinary, and an LLC is kind of normal, and one for passive, and an LLC is normal here. The difference is that on this ordinary income, once you are above about $30,000 in sales, usually, really the number that matters is profit, but we're $20,000 to $30,000 in profit. You're going to want to keep this LLC in place, but have it taxed as an S Corp. But this S Corp should always be 100% owned by you so that you control it completely. Now, what if you're in a partnership? Well, the partnership would fall under here, and you would actually own your share in the partnership through this LLC rather than under your personal name. And by doing that, you keep that partnership really simple. So you're not trying to mix multiple partners' deductions. If one partner, wants to drive a Ferrari and the other one is driving a Camry, you don't have to worry about balancing those things out within that partnership. The partnership stays super simple, and you, within your own entity that you control completely, have full ability to manage your own deductions and accumulate your own deductions in there. And the other reason is, for most business owners, eventually you're going to be involved in more than one business. And having it set up this way allows you to put additional businesses under here as needed without having to multiply the wages and the salary that you pay yourself. So we end up paying, a 15% penalty tax, employment tax penalty on every dollar of wages that you take. And that's required within an S corporation. And it's still worth it within the S corporation, but we don't want to have multiple S corporations where we have to take wages out of each and every one of them. So we want to have one S corp that's completely controlled by you, and then everything that's ordinary activity for you, ordinary business income, would go funnel into that LLC, usually S corp, and funnel up to you. And then the same would be true for any passive activity. So that could be other LLCs that are completely passive to you, where you've invested, but you're not involved. You're maybe a limited partner, and those would funnel into that LLC. Additionally, any rental properties or other real estate would funnel into that LLC. And you can get a little more complex with this with things like series LLCs, but I'm not going to get into that right now, just in the interest of time. This is a little bit higher level. You want to have one for ordinary and one for passive. Now, this structure will take most business owners through that 7-figure in wealth point. Once you start to get beyond that, then you get into, well, what are the entity structures that are going to take us beyond that? And the things that we run into at that point are, we need to get income off of your personal return. Generally speaking, we can use accelerated depreciation. So we'll talk about this here in a little bit within wealth strategies, but using depreciation on rental properties, or even there are other kinds of even oil and gas investments. There are many kinds of investments you can make where you can take a portion of that investment as a deduction, essentially making the investment pre-tax or a chunk of that investment pre-tax. And so there are a lot of things that we can do to organize it that way to allow you to have investments that reduce your income. But what I have found is, practically speaking, at that point, you're still ending up with a lot of income. And that income is taxed at a really high rate, and it's phasing you out of a lot of the benefits that are available to you at lower income levels. And so it's at this point that we start looking towards other entities to figure some of this out. And sometimes that can be a C Corp. And C Corps have their own positives and negatives, but we can either take, you know, one of these entities and have it be owned by a C Corp, or we can carve out a portion of, use a different color. We can carve out a portion of this LLC and a portion of that business and move it over to the C Corp. Ultimately, what we're doing is we're shifting some of the profits from these entities that are pass-through entities and flow up to you over to another taxable entity where it's completely off of your return. And then that C Corp will do its own investing and have its own assets under there. Really, the more your wealth grows, the less of that wealth will be owned under your personal name. You maintain control of it, but you maintain control through some of these other entities and structures that you form. So a C Corp is one. Another one is trust, or is a trust. And there are a lot of different kinds of trusts. I'm only going to talk about, briefly, two of them right now. One is just a living trust. And the only reason I'm mentioning this is because it's a common misconception for a lot of people. So a revocable living trust is what a lot of people have. You should have one. If you don't, you should get one. It's very, very basic, but part of estate planning, and but it doesn't do anything for you for taxes. It keeps your assets out of the courts and out of probate if you pass away. And that's the only point of it, but it's still useful and you should have one. But that trust doesn't do anything for taxes. The kind of trust that we most often see for tax benefits is what's called a beneficiary dependent investment trust. And this type of trust is what we would use to shift some of this income, if you have an LLC, as an S corporation, and some of the losses that are passive. So if you're running into passive loss limitations, this is one possible strategy, not by any means the only one, but it is a common one to get around those passive losses, those passive loss limitations, and allow you to take losses that you might have in these properties and be able to deduct them against ordinary income. Because what we end up doing is shifting some of your ordinary income into this trust. Let's say $100,000 we shift into the trust, and then we have a $100,000 loss here through the rental property. Well, the $100,000 of income that we're shifting is passive to the trust, as is the $100,000 loss. And so those two end up netting each other out and going to zero. So this is technically a taxable trust, and we don't usually want to pay tax in trust because they have higher tax rates. But this is a taxable trust, but we're zeroing out income, so it won't have any taxable income. And these are a little bit more advanced tax strategies, but ultimately the results that we see with these kinds of tax strategies are massive. What we're talking about on the simpler level for newer entrepreneurs is anywhere from $5,000 to $15,000 or $20,000 in reduced taxes every single year. And that's not even getting into the more complicated entity structures that we're talking about. And for entrepreneurs who are a little bit further down the road, we're talking about $50,000, $100,000 in taxes lowered every single year just by proactively planning and carefully maneuvering around to say, well, where do I want this income to fall? How do I make sure that it's taxed and flowing in the most efficient way? Okay. Now, next, regarding deductions. So in order for something to be a deductible expense, it has to meet the test of ordinary and necessary. And the key to this comes down to you've got to ask the right question. You don't want to ask for any major expense. Can I deduct this thing? Can I deduct my house? Can I deduct my car? Can I deduct the boat that I want to buy? Can I deduct my kids' college? Because the answer on all of them is it depends on your situation. And for most of you, the situation that you have right now, the answer in a very black and white sense would be no, you can't. You can't just take that thing that you want to deduct and write it off. But if we change that around to say, well, how can I deduct it? How would I need to just organize my life differently so that I could take this thing and make it into a real deduction that is completely legal and legitimate and it's something that I don't have to worry about, don't have to lose sleep at night. And that difference comes down to being proactive and asking that question so that you can set up your circumstances to make it legitimate. But it also is just a good practice. One example I love to give on this is we had a client, his name was Nate, and he was a dentist, and he wanted to buy a tractor. Is this one of those like Kubota tractors, like $60,000 tractor, so not cheap. And he's a dentist, so that's not ordinary and necessary for a dentist. So if he asked the question the wrong way and said, "Can I deduct this?" the answer is no. But if he approaches it differently and says, "How can I deduct this tractor?" then we can start thinking and saying, "Well, how could we make this tractor ordinary and necessary for you?" He owned the office building that he was in. So what he did is set up a family management company for that office building and have the family management company start doing the landscaping instead of paying a landscaper for it. And now all of a sudden we have a property management company that is it is ordinary and necessary for that company to purchase a tractor to use in maintaining the property and ultimately properties that he ended up acquiring. Now, that's the kind of thing. It takes this $60,000 purchase down after we get the tax benefit to $45,000 purchase. So the government is essentially subsidizing the purchase of the tractor, which is fine. They're fine with that. They would say, well, we want to stir the economy. We want to keep those things moving. And then they have the ability to, and they say, well, so we'll help with this as long as it's an ordinary and necessary expense for your business. Jackson, to your question about what happens when they start using it for personal use, I guess that's something where I would say that's de minimis. Like the fact that it also gets used for some other things on cell phones. Like we use cell phones for personal and business, but the IRS has kind of given up on that. This is not a vehicle where we have to track miles. So we have a legitimate purpose for it to be used for the business. And, there's nobody really keeping a time log of the hours and what it's used for when. So that's one of those things where like a lot of CPAs are really nervous about that. And they almost like will avoid any hint of risk or they see the world very black and white. But, what I would say is like, what we're trying to do is take the incentive that's there, have this be a personal asset, have this be a business asset. And then if it takes it to use for a weekend to do what, play in the dirt that he wants to, like that's not a significant deal. So the other items here are kids' college, where we want to be paying your kids through the company and let your company pay your kids for real work that they do in the company, age appropriate. Can be modeling to be on the website, can be taken out to trash, can be, as they get older, helping with social media and marketing. But pay your kids, have them work in your business and pay your kids. And then you can deduct what you pay your kids through this family management company, and then have the kids put their own money into college savings, either through a Roth IRA or even a more traditional savings account. So there are lots of things that you can do for that. State taxes is one of the most commonly overlooked ones that we see, which is sad because it's so, I don't know, it's so obvious, I suppose, but the limit on state taxes was set a couple of years ago with the Tax Cuts and Jobs Act at $10,000. So you can't deduct more than $10,000 state and local taxes. That includes property tax, which for a lot of homeowners, you're $5,000 a year in property tax. It doesn't leave a lot of room for state income taxes. Most states now have enacted pass-through entity tax that'll let you, if you pay your income tax through your company, instead of waiting and paying for it personally, then you can deduct that expense through the company instead of getting capped and being limited and not being able to take that personally. I'll in the interest of time, I'll keep it moving. And is there a certain percentage of time where it gets concerning? Jackson, good question. Yes, it does need to be at least over 50% business use. As long as we're over that threshold, then we can consider this a business asset primarily. Okay. Final thing that I wanted to go here was to talk about one specific example here. And this is Laura. And Laura is, depending on where you are at, so for whoever's watching this, like, you might be in different situations. And Laura's situation, the only thing I would say is so incredibly common. You know, one might think, I would think that at this level, there are way more people that this would be pretty rare, but it's not. So Laura and her husband run a plumbing company, and they were making $170,000, but they had an LLC, and their accountant still had not had them switch over to an S corporation. So they were getting absolutely murdered on self-employment tax. On that $170,000, they were paying about $26,000 in self-employment tax. And in addition to that, they had several other things that they weren't doing. So what Laura was able to do with looking at her taxes in a proactive way, took this $26,000 in self-employment tax. She turned herself into an S corporation and traded that for about $5,000 in payroll tax by splitting that up and saying, let's be an S corp, let's pay it a reasonable wage, and then take the rest as profit that is not subject to self-employment tax. That alone saved her almost $17,000 in tax. And that's going to be something she's realizing year over year over year. And the more her income goes up, the more she would end up saving. The other one is she was going to buy a Dodge Durango, which is a significant purchase for anyone, and happens to be a vehicle that is over that weight rating of 6,000 pounds that allows you to deduct the whole thing if it's for business use. And in her case, it wasn't for business use. And Jackson, to your question, for cars, you have to be more careful on this. So she initially asked that question of her CPA, can I deduct this? And he said, well, what are you going to use it for? And she said, well, I work from home. I don't put a lot of business miles on it. And so the answer was no, it's going to be under 50% business use. There isn't really a way to deduct it. But thinking about that question differently, saying, hey, this is a significant purchase. This is like a $60,000 purchase, $65,000 purchase. Let's not ask if we can just deduct this. Let's say, how can we deduct this? How can we organize our business and our life in a way to make this into a deduction that we can buy pre-tax instead of waiting for after-tax money to buy it? And the answer for Laura was that she has pretty much a daily route that she goes on. Taking the kids to school, if she needs to go to the grocery store or whatever, and then back home, and then same thing to go pick them up, right? So for Laura, she opened a mailbox for her company that was right near her kids' school. So now every time she pulls out of her driveway, she's leaving to go to that mailbox first, leave a couple minutes early, go to the mailbox, check the mail for the business, and then that becomes a business trip to that mailbox. Now, from the mailbox 2 blocks over to the school, those are personal miles. That's fine. But the majority of that trip is now a business trip, and the trip home is a return home from that business. So you're leaving from your home office to a business destination, then a quick personal thing that we don't worry about, and then home, which is business again. So we're shifting around how we define this, and we're setting up a scenario that creates legitimate business miles that allows this $60,000 purchase to be something that we can deduct. And again, this just going to keep reiterating it, but I'm going to keep reiterating it. This comes back to thinking proactively and saying, well, this is coming. I want to do this thing. I can't deduct it. What's the obstacle? How do we figure it out so that I can get from point A to point B? And for Laura, for this year, again, this was a $9,000 difference in her tax, being able to deduct that versus not being able to deduct it. This is where this starts to, this adds up to real money. Think about what this money turns into, invested back into your business, or taken and put towards some other investment, or rental property, or I don't know, whatever it might be for you, like whatever your passions are. We can take this money that otherwise would just be gone out the door, never see again, just an expense, to taking it back and then intentionally saying, okay, I know I'm reclaiming this money. This is found money. What do we do with it? How do we invest it? How do we use it to grow to accelerate that trajectory and that flywheel of wealth? And finally, the accountable plan and Augusta rule. Honestly, in the interest of time, I'm not gonna go into those. You can look up accountable plan and Augusta rule and learn a little bit more about those. But again, it comes down to like being proactive and ultimately taking expenses, both of these mostly related to your primary home, and shifting those as legitimate business expenses. And again, you just can't do it retroactively. You can't get to the end of the year and be like, oh man, I wish I would have done this. I wish I would have figured out a way to use business miles so that I could deduct that car that I purchased. I wish I would have used my home and used the Augusta rule for my home. If you didn't, you didn't. And you can't go back and just change it. You have to set it up proactively so that you can utilize it. That's another $1,600. Total, Laura's taxes dropped by $27,000 from about $40,000 to about $12,000. A lot of money, $27,000 1 year. And most of that's going to repeat year over year over year. This is important stuff. Okay. So now big picture, like, why does this matter? And we've talked a lot about that kind of the arc and the trend line. So I'm just going to go very quickly through this, but the average savings rate here is about 5%. That's what's left after we get through everything. We have our income, we pay taxes, then we cover our expenses, and then what's left is what we can generally save and invest in. This is why it takes us, on average, 30 to 40 years as a country to get to retirement, because we're like, everything comes out first, and then we're trying to figure out what's left, and then we put it into investments that we don't have control over, that we're investing less, we don't have control over it, and we don't have any expertise to get any kind of outsized return on that investment. And those are really the three ingredients. To grow investments quickly, you want to be able to have control over it, you want to be able to leverage it, and you want to be able to have some kind of knowledge in your own head that lets you do better with that money than someone else who doesn't know what they're doing could do with that same money. And then if we could take that and do it all pre-tax, then it gives you more to put into those kinds of investments. So this is why it matters so dramatically. This is just a quick chart of the average savings rate in the US, now 3.4, generally, again, 5 to 8% historically. So how much are you overpaying in tax? Rhetorical question, don't answer, but do think to yourself, how much, based on what we talked about with entity structures, with deductions, like what are you leaving on the table? How much opportunity is there for you to lower your tax? And then what would you do with that money if you had it? How would you invest it? Where do you want to go? What are your long-term wealth goals? What kind of growth do you want to see in your business? What kind of growth do you want to see in your assets outside of your business? The average entrepreneur is overpaying by $11,638 every single year. And again, that's average. There are a lot of entrepreneurs who are overpaying by a lot more than that. It's devastating. If you just go back, I don't want to be over dramatic, but I want to be appropriately dramatic, because if you go back to that graph and note that difference between those two trend lines of what happens, you take that money, reinvest it. Next year, you're making more and have the same tax strategies to again, save that money on taxes, reinvest it. This is where those trend lines really start to differentiate over time. And all of a sudden you look up 5 years down the road, especially 10 years down the road, And you've got two totally different outcomes that all really started from this, like that train track that just shifts like a couple of inches over, and then a couple hundred miles down the road, they're so far apart that you can't really even understand that or it's difficult to fathom that it just started with that small little shift. So, okay. A lot of you might feel like you've been drinking from a fire hose. We've gone through a lot. We've talked about, a fair bit in detail on some of these entity structures. If any of you, I'm going to answer questions here in a minute. So if any of you have those, you can put them in the Q&A or in the chat. Either one is completely okay. And let's see. But I guess before we do that, I want to let you know what, if you are feeling confused, if you are feeling overwhelmed, we have a pretty inexpensive option to get just a little bit of clarity and to understand like what this journey would look like for you and how you can go from wherever your frustrations are right now to at least understanding what the next steps are. How do you get some clarity around your taxes, some clarity around your financial objectives, and how you can start to get a path that makes sense from point A to point B. So what we're offering is a deeply, deeply discounted one-on-one call with me to create a tax and wealth roadmap. And what we do on this call, it's a 1-hour call, and we run through these numbers for you. We start out with your baseline. We'll say, okay, well, what are you going to make this year? And if you don't know, I'll help you figure it out. We'll just talk through it, and we'll understand, okay, what are you going to make this year? What is your tax return going to look like in April based on what we know now if we don't do any tax strategy at all? And then we'll go through and talk about, well, what are your options as far as entity structures go? What are your options as far as deducting any major expenses or deductions go? What are your options as far as investments and wealth strategies and shifting income tax brackets to lower bracket options? And so that's the call. By the time we get done with this 1-hour call, the idea is that you have something that looks like this, that says, if I don't make any changes, here's what I can expect in April. If I do X, Y, and Z, then here's what each of those would save me exactly in dollars and what I could then expect to pay in April. Additionally, I have a course that goes through tax strategies. I want to be very clear on this course. This is not an advanced tax course. Basically, it covers the strategies that we talked about in this webinar. It's intended for newer business owners. So if you've been doing this a little bit and are looking for more advanced strategies, the course is not going to be where you find those. That's going to be where we'll discuss those in our call. But it goes deeper into detail on things like S corporations and partnerships. And we have a couple of different modules. We have one on entity structures. We have one on deductions. We have one on wealth strategies. And we have one that we didn't get to today on audit risk and how you can lower your audit risk. So all the stuff I didn't have time to get to today is in there. Additionally, we have fillable, templates, forms, tax calculator that you get, and a handout and that bundle. Normally, a one-on-one call with me for an hour is a $500 call. The course we normally sell also for $500, $497, and the tax planning bundle we also sell for $97 generally. But we're putting all those in a bundle and then discounting it pretty deeply. And I'll get to price here in just a second. But a question I often get is, well, do I have to fire my CPA? The answer is no. For a couple of reasons. First, we do have a CPA firm where we actually service clients. That is a piece of what we do, but what the objective here is to just get you that very first step and just say, let's get you some clarity. And that's it. There's no ongoing commitment. There's no anything. You can keep your CPA. You can treat this like a second opinion on your taxes and keep your CPA and get clarity. Or if you don't have a CPA, that's okay. You don't need to commit to us. This is a 1 hour, essentially a consultation. And, how much would this be worth to you? If you're average and you're overpaying $11,000, how much would that be worth to you to get some clarity around where you're overpaying, what things you could do to lower your taxes? Ultimately, we're just charging $97 for this. That's it. And transparently, it's because I hope to provide you so much like individual value on this call that you decide to work with us in one of the many ways that we have available that we can talk about after that. So the goal of this call is not to like sell you and close you on something, is to provide value. Then from there are options on how you might work with us and what things we can do to help you. Again, my objective here is to be, I have gotten onto so many calls with small business owners, generally business owners with more money. You're fine. Like you can find a big A accountant. It's the small business owners who are stuck in that spot where they're paying a CPA, maybe a couple thousand a year, maybe, maybe even less, maybe you have a really cheap CPA. And I would get on calls with entrepreneurs like that and have these conversations about strategy, and then they wouldn't have anywhere to go. And they would say, well, what do you suggest? Since we were too expensive, they weren't going to work with us. There was no option. So the idea here with Contigo Advisors is to create options, to productize some of this stuff, to allow me and us to deliver this kind of support for new and small business owners in a way that is more economical and more available, and is practical and just affordable. So if all honestly, on this 1 hour call, this should be my feeling is that there's so much value in this that it should be, just a no-brainer if you're all interested. If I only helped you with any of these things, like if all I did was help you lower your tax bill by a couple $1,000s every single year, if all I did was help you get clarity around your cash flow and like what's coming and what you need to expect and how to plan for it, that would be worth $100. If all I did was help you reduce your risk of an audit, that would be worth $100. Or just help you get a little bit of acceleration on your wealth accumulation, or just be able to go back to your CPA and hold them accountable and say, hey, what about this and this and this? That's worth $100. On the other side, or if I helped you avoid long-term, like unanswered emails to your CPA, where you've been waiting for questions on something for a long time that you're not getting answers to, or even just unnecessary expenses in your business, which happens all too often because people are so desperate to save on taxes that they'll end up buying things they don't need, that don't have any value to them, just to get a deduction to try and lower taxes. So it's pretty easy to justify this at $100. There's so many different ways that we can help you save money and help kind of accelerate your trajectory. And again, honestly, on this call, my goal is to bring a lot of value. So $97. That's it. The link, Jared put it in the chat. So if you're interested, you can go there, and I will take any questions that we have now. If you want, just go ahead and put those in the chat. Jared, if anyone has sent you any private messages or anything, if you just paste it in for me, and then I'll take them and go. Okay. Thomas is asking about an S corporation. How do I know how much I should pay myself through my S corporation? So, Thomas, through the S corporation, you want to pay yourself as little as possible in wages, but it has to be, quote, reasonable, which is vague. So how do you make sure you're reasonable, but not on the high side of reasonable? There are a couple of ways to do it. The more detailed way, there are several services out there. I won't recommend any, right now. I don't want to make any endorsements or anything, but there are several services out there where you can go and basically input your information, and then be able to, it will tell you based on that, and based on where you live, it'll say, okay, your profession, your how many hours you're working, your business size, your location. This is the reasonable salary range. And then you can kind of use that as a rule of thumb. And a lot of those places will actually give you a report that you can save with your tax information, so that if the IRS ever questions the reasonableness of your salary, you've got backup. And the other simpler way is just kind of the rule of thumb is 1/3 of your profits. And then you kind of adjust that as appropriate. So if your profits, generally, the lower your profits are, the more you want to be on the high side of that 1/3. So if you only have $50,000 in profits, then, $15,000 might not be a reasonable wage based on what you're doing. You might want to, adjust that up and still have like a $25,000 reasonable wage. But you got to think, for a company that size, it simply couldn't afford to pay really expensive employees. So Anyway, and then as your numbers get higher and higher, so you're making $500,000, it doesn't mean that you have to have, doesn't mean that you necessarily have to have a what would that be, $150,000 payroll if that's not what your job justifies. So if you're again, like blue collar, like Laura and Don, he's a plumber, so he's got to pay himself for the work that he does as a plumber. It doesn't have to be necessarily incremental and stay with that rule of thumb forever. So let's see. Okay, Jenny, let's see, can you help change entity structure? Yes, we can. I had to leave for a 30-minute meeting. Yeah. Yes, absolutely. So a couple of things. Entity structures are, generally speaking, there are two things when it comes to entity structures. The first one is legal entity. That is the LLC. And usually we're not changing that. There are exceptions to that, but generally speaking, if you have the LLC, we're going to leave that LLC alone and keep that as your legal entity structure. And what we'll be changing is the tax structure. So it's sort of like, take that existing LLC and we slap a label on the front of it and say, this LLC is being taxed as an S corporation. And that's how you do it. And yes, we certainly can help with that. And in fact, depending on kind of where you're at, the course is intended really to be kind of so we can help with it, period. But also included in that $97 for the call is the course. And the course includes templates on how you can do that. Basically, the form that you need to download. We've got an example form you can download side by side. So you can look at this one that's already filled out, download the blank one, and then fill yours out right next to it, and then submit it to make that change yourself. And again, or we can help with that. Dave, do we help online business owners strategically relocate to a state with better tax benefits? We absolutely have done that, 100%. So, I mean, that's maybe too short of an answer, but I'll expand on that a little bit. Sometimes that's worth it, and sometimes it isn't. It depends on the states, depends on your situation, depends on all that stuff. It honestly depends on your state of life too, because this is one of those things where like it has to be real. So, we have lots of clients in California. And a significant portion of those clients at some point starts looking over at Nevada and saying, well, it's only that much of a drive and zero tax versus what I'm paying here. And maybe I can do that. When it comes down to it, you got to think about stuff on the personal side. One, you got to calculate, like, what is it going to save you? And then two, you got to look at stuff on the personal side. Do I have kids in school? Do I have, like, what are my ties to the community? How big of a deal is it? But I mean, yeah, we have one that comes top of mind. It was an online business guy who lived in Arizona, but wasn't really tied to that state. He's actually originally from another country and wasn't really tied to Arizona, was just kind of had ended up there. And he ended up relocating to Florida, and he's making $2 to $3 million a year. Like, that's a huge amount of money that he's saving every single year in state taxes. So he can still go back and visit Arizona whenever he wants. Not a big deal. But for a lot of situations, it absolutely makes sense. And might also make sense if you ever have like a large payout. So if you're selling a business, again, that really gets into a lot of details on what the overall circumstance is and where's the business located, and are you going to end up paying tax in that state anyway, even if you're not there. But those are the kinds of things that we would absolutely want to look at and figure out. Any other questions? Let's see, I have about 15 minutes, but if we don't have any other questions, I can go ahead and jump off. Okay, we've got one from Anonymous. All right. Anonymous asked, if you invest $100,000 of your money, buy a property through an LLC, is that deductible in the first year you give that to your LLC or not? If you invest $100,000 of your money to buy a property through an LLC, is that deductible in the first year you give that to your LLC? Okay. I think the word give, I want to be careful with that, because I think invest is that deductible when you invest it. And for this, I will give an example. If you've got your entity structures here, and you probably have some sort of ordinary business, and then you have your investment LLC. And you've got profit flowing up to you from this ordinary business. And then the cash is here, it's yours, right? And then you're going to take this cash and you want to put it into this LLC, ultimately for the LLC to buy rental property. I think we're talking about here, buy a property. Yeah. Okay. So if this is $100,000 going out, is that $100,000 deductible in year one? Not simply for the fact that it is, not simply for the fact that you invested it. So if there was no rental property involved and you just invested the $100,000, there's no deduction. What makes it deductible is something like the following circumstance. So if you took that $100,000, and that would be 20% of a $500,000 investment property. So then you took that and invested it into real estate and use that as your 20% down. So you now have a $500,000 asset. And then you take that real estate and you do what's called a cost segregation study on it. So normally real estate, if it's residential real estate, like a home or a townhouse or anything like that, that's depreciated over 27 and a half years. So you've got to wait almost 30 years to get your tax benefit to take the depreciation for the wear and tear on that building. And if it's a commercial property, it's worse. It's 39 years. So your timeline to be able to expense that investment out and take it is decades and decades. What a cost segregation study does is it allows you to break that building down into its smaller components and be able to say, the structure of the building might be 27 and a half years, but the drywall isn't, and the electrical isn't, and the flooring isn't, and the window fixtures isn't, and the lighting and the just all these different components of the building have a shorter lifespan than that. And so a cost segregation study is like an actual engineering study where they come in, they'll look at all those things, break them down break the building down into its components, and then let you take a significant piece of that depreciation and let you take a significant piece of that building in its component parts and then depreciate it as individual assets. And those individual assets have a much shorter lifetime and are also eligible for special depreciation or bonus depreciation or even Section 179. So it lets you take a significant portion of that building and essentially depreciate it in year one. So now, usually that ends up being like somewhere in the range of about 25% of the building. So what is that, 150? 125. So 125, this now becomes a deduction for you, plus some of the building itself. And then that rolls up. And so for that $100,000, not because of the $100,000 itself, but because of what the $100,000 did and how you invested it and what that turned into, you now have a $125,000 deduction for the $100,000 that you put in. So longer answer, like, yes, it is deductible, just in more of a roundabout way. And then the other thing you've got to be careful of there, Anonymous, is that may very well be passive to you. There are, again, many ways to avoid that passive loss rule. And, again, that's something that I probably won't get into because there are so many different ways, but you can get around that. You just be aware that that's an obstacle. If you don't do anything carefully to plan for it, that 125 can come back up and hit like a wall right here because it's passive. And then you'll just end up having to bank it and carry it forward year over year over year over year. And then it, doesn't really do you much good. So, okay. All right, let's see. Okay, Nanette asked. So it's now June 2023. Will getting an LLC S Corp started now be able to be backdated to January 2023? 100. Okay. Okay. If you have an LLC already in place, which is not what you said, I'll get to you in just a second. But if you already have an LLC in place, this is why I would encourage anyone, if you don't have an LLC yet, if you're just getting started and you have your business and you don't even think maybe you're ready for an S Corp yet, I don't care. Start the LLC, open that LLC, because it gives you options down the road to take that LLC and just slap a label on it and say, and you can do that late, right? You can absolutely do that in June and say, hey, sorry, this should have been filed back in February. It's late, but here's our explanation, blah, blah, blah. And the IRS essentially always accepts it. So just having that LLC open gives you a structure on which you can just put that label whenever it's convenient. And then you don't really have to rush to put that label. You just wait and just see, let's see how this year goes. Okay, we're here through October. Okay, now, yeah, you know what? Things kind of took off. We better be taxed as an S Corp. Let's go back and put that label on that LLC. But the further along you get in the year without the LLC, the more challenging it becomes to get the business, to open the LLC and get it started. So there are a couple of things you can do for that. But the easiest one is I still would open that LLC, Nanette. I would open that LLC and get it moving and have it filed probably as an S corporation right away. And then what you do, it just requires a little bit more work. So you might have some people who paid you under your personal social security number. And at the end of the year, they might send you a 1099 to your personal social security number instead of to the business and the LLC. You want to be as proactive as possible in trying to combat that by going to them and saying, hey, by the way, I have an LLC and an S Corp, and I need you to send the 1099 to this S Corp. And most people will do that. Bigger companies or like credit card processors, they often won't. You'll have to like open a new account with them under the LLC and sort of start that over. That's not an absolute, but is often the case. And that's even okay. So then whatever you get that is sent to your personal social security number, at the end of the year, you just go through this process called nominating it to your S Corp, which is just a way of telling the IRS, hey, I got this income reported to me. I got this 1099. It belongs over here on this S Corp. And I'm like reporting the income, and then I'm just going to report it as nominee to the S Corp. And then it ends up zeroing out on your personal return. And again, I won't get into the details on that. Just that's the word to remember, nomineeing the income, so that when it comes time, you can look it up. And in fact, you can have someone do it for you, or if you're doing it yourself, like the IRS has a specific procedure that's on their website. This is exactly how you do it. This is what you report. These are the words you use. This is how you do it. And it's not, it's not rocket science. Okay. Jenny asks again, are charitable donations you make in your LLC deductible, or do they need to be made as sponsorship marketing to be deductible? Good question. If they are sponsorship, then they are advertising. If you're not receiving a benefit for them, then they are charitable donations. They are not, charitable donations are not deductible within an LLC, but you don't lose them necessarily. So what happens is they just get reported as a non-deductible expense in the LLC, and then they carry through to your personal return, and then you would report them on your own personal tax return as donations. So if you're itemizing on your personal return and breaking out mortgage interest and taxes and medical expenses, if applicable, and all that stuff, if you're doing that and you're over the standard deduction, then you'd carry that benefit through to you. If you're taking the standard deduction personally, then you would frankly lose out on it. So where possible, it would be better for you to define those as marketing expense for sponsorship. rather than as charitable donations. Then you just avoid the whole thing. Okay, and Dave asked, following up on my last question, do work with online business owners who are US citizens but travel internationally the majority of the year. If I relocate myself and my business to Florida and I'm not there often. Oh, that's funny. Dave, I wonder, the client I was describing earlier is actually in a pretty similar situation. I think he's in Spain right now and has been there for a while. So the answer is yes. Not there often, assuming you have a physical address and driver's license. Yeah, absolutely. That makes sense. There's no reason for you to have like your official domicile in a state that has taxes, especially a state that has high taxes, if you're not even physically there most of the time, because you'll be taxed as a resident there regardless. So you might as well change that residency to a no tax state. And then, and since you're not physically in any other state that would be requiring you to pay taxes, then it solves that. So I think that's it. If there are any other questions, this would be the time. Hang on for a few seconds. Otherwise, thanks so much. I really enjoy this stuff. I really enjoy getting your questions and just hearing this stuff and talking about the different strategies. So thanks for participating. Thanks for your time. And if you, just use that link, Jared, if you want to include it one more time, use that link to book a call with me if you want to. And then we've got a bunch of other free content, even if that's not right. Just, stay following us on either Instagram or YouTube, and we'll continue to post different strategies and things like that. Try and help you guys out as much as possible. Thanks, everyone. Have a great rest of your day.